This is another infographic instant with Brian Michael. In this episode, we'll be looking at whether international stocks help grow a wealth manager's client list. Recall that these infographics are from a paper where we have looked at the strategies that international broker-dealers and private bankers can use in order to do two things. First, we look at the extent to which they can grow the wealth of their clients and thereby earn more commissions on assets under management. And second, we look at how to increase the number of potential clients that they can add to their client lists, thereby also increasing their commissions. Now, one of the topics that we look at in the paper to answer these questions is the extent to which holdings of equity and debt helped increase the number of affluent people in a population. In our paper, we looked at three main groups of clients and potential clients for wealth managers. First, we looked at ultra high net worth individuals, those that have more than $20 million in wealth. Second, we looked at high net worth individuals, those that have more than $1 million in wealth. And third, we looked at affluent investors or savers, those that have more than 100,000 US dollars in wealth. So given those categories of potential clients, we wanted to see what is the relationship between their foreign equity holdings and their foreign debt holdings. Of course, we looked at domestic holdings as well, but for the purposes of this infographic, we want to consider their holdings of foreign equities and foreign debts. And we do that because we're interested in knowing what kinds of strategies these international broker-dealers can use to penetrate foreign markets. Naturally, being able to offer foreign equity and foreign debts would represent an important potential strategic weapon in entering some of these markets. And what we see in the infographic in front of us is that as the proportion of affluent in a population increase, their extent of foreign equity holdings increases far more quickly than their extent of foreign debt holdings. So in other words, as a country moves from the level of, let's say, Botswana to Czech Republic all the way to Germany, we see that those individuals tend to accumulate far more foreign shares of IBM or Costco or Sainsbury than they do in debt holdings. Now, the puzzle remains, well, why would that be? Why are foreign equities better in some way? Why are they preferred by these investors? And there's little doubt that one reason is because of liquidity. It's much easier to buy shares and it's much easier to get information about shares than it is to get information about bonds. So in some way, the very imperfect international market for debt helps to contribute to this situation. This is particularly surprising when we consider that investors tend to prefer debt instead of equity as a bulwark of their portfolio in order to provide some amount of safety and some amount of potential offset to the risks of equity markets. So in theory, in perfect bond markets, we should see higher amounts of foreign debt holdings than foreign equity holdings. This data suggests two things, I think, about marketing strategy for broker-dealers going into emerging markets. First, it means that the current market is highly favorable for offering international equities. However, and second, it also implies that room for growth for bonds is very high, particularly in light of the fact that investors traditionally prefer to hold a fair amount of their portfolio in debt in bonds. Therefore, to the extent that international banks can reverse the two lines you see in front of you, that will help their competitive strategy and hopefully increase commissions that they are earning. This has been Brian Michael with another infographic instant.